Can
Andy?
you make me a host, please, mate?
Oh, yeah. I'll make you host. All right, make a co-host. There we go. You're a co-host. Mate, welcome to Friday afternoon, Wine and Wisdom. A few people going to get themselves logged in soon, I'm sure. But, mate, what do we do? Kick off. You've got the goods. Make it happen, mate.
Let's do it.
That's awesome, mate. Love it. Good job. Welcome, everyone. Another Wine and Wisdom on a Friday. Andy and I were just talking. We both planned on having a bit more of a relaxing Friday, getting organised before Wine and Wisdom. But as the day does sometimes, it gets away from you. So been a hectic day. Hopefully everyone else has had a better day time-wise than us. Anyway, I've had a productive day, which has been good. But for those joining us for the first time or coming back, welcome back, gang. But those who are joining us for the first time, Andy Fenton on my left, on my right. Am I right? Can't see. But thank you for joining us. Andy Fenton, the world of finance, all things shares and banking. Myself, Jason Witten, all things real estate and finance. And we've been debriefing every Friday for close on 6 months now, calling it Wine and Wisdom. Sometimes a lot more wine than wisdom, but every now and then a bit of wisdom comes along. And last week, Andy was drinking some smart wine, which was good. But folks, welcome along. We have a bit of a chat about what's been in the news or top of mind or topical for the week in our world, supporting our networks and our clients. Andy in the business world and the share world, me in the property world. We've got clients and people that we support through our businesses and what we do, coaching and helping. So this is our debrief. This is our Wine and Wisdom debrief. So welcome along, mate. So how's the week been, mate? What's on the agenda for tonight's Wine and Wisdom with you, mate? I've got a couple of little things. I'm going to talk about the records of real estate tonight, the records of real estate. So a few little interesting tidbits to chat about there. But what's on the agenda in your neck of the woods, mate?
Mate, not too many articles on my side of the equation tonight. But firstly, have to acknowledge it is a special weekend down here. It's grand final weekend down here. The team that should be in the finals hasn't made it in, but I think we've got a fairly balanced representation here of Geelong.
I was going to say, mate, yeah.
Mate, so, but you know, I balance it out. I do have the Tigers down here somewhere. Had the Tigers down here. I think that's about enough. So I think we know where my loyalty lies for the course of the weekend. But mate, competition. I mean, healthy competition and unhealthy competition is perhaps the theme for the weekend. And also another great example about how markets love consistency and information. So straight off the ranks, mate, it's been an interesting week from reporting. What is coming up as far as reporting season is concerned, seeing a lot of volatility across markets, both domestically and abroad. And it's going to be very, very interesting because we have, I think it's race weekend down here, the spring racing carnival on that faithful day in November, which is going to correlate with the great election, which is over in the States. We still haven't seen stimulus. We see when there's perhaps stimulus is on the cards, we see the market rally hard. When they sort of go, oh, we almost got there, we see markets fall off. But we did see a little bit of a rotation yesterday, which will be interesting to see whether we see it going forward. But, you know, I'd been talking about that value rotation out of growth stocks into value, and companies like GE, Wells Fargo actually had a ripper run yesterday or last night in the markets. It was up about 5 or 6%, which was probably one of the best runs it's had for a little while. I'm not saying that it's going to continue that, but it was a big cycle out of growth and into those value-based stocks. So the S&P went higher, but higher based on tech growth being flat and more of those sort of fundamental value stocks coming on board. But one of the great ones that I'd love to articulate here, and let me see if I can find it in my little investment app here, is there was a clear winner in the equity markets over in the US. And these guys, and it's a very, very well-known firm, and we've seen it happen in Australia. So just before I go to the app, let me give you the background. Goldman Sachs, right, takes millions from executives. So the bank will pay nearly $3 billion and recoup $174 million, $174 million from investors. Right, because it broke US corruption laws. So as a result, agreed to pay what is an absolutely massive fee. So you would imagine Goldman Sachs executives feeling a little bit touched up, and you would imagine that the share price would be pretty touched up as well, wouldn't you, Jace?
Well, you'd think, all right, well, mate, but it's gone the opposite way, right? Like bloody Westpac. That's what you're going to tell me. I get.
So this is. Oh, hang on. Let me see if I can get it up for you here. Oh no, yes. So there we go.
Yeah. So put yourself in the corner.
For some reason,
can't do the picture in picture.
Oh, there we go.
Oh, yeah, there you are.
I'm back there today. So this is, ladies and gentlemen, this is what apparently happens to a stock these days after it gets sued for $3 billion, recouping 174 million from executives. It actually has a rally, and if you have a look at where it's been going over the last week, or even the last month has been reasonably good, but the last week as this pending case came to conclusion, all of a sudden, as soon as we know, bang, it's got a whopping fine. All of a sudden, up 2.49% for the day as investors feel far more confident in getting into a position where they actually have now realised the outcome. And it goes to show just how important knowing is when it comes to market sentiment. Hilarious.
And it was the same the other month, wasn't it? When Westpac got their fine, $1.2 billion, was it Westpac's fine? I can't remember the number. It was pretty large. And then I was like, what's going on here, Andy? How did the shares go up the day after they got fined such a huge amount of money? And you're like, well, the market likes certainty. Everyone knows that that's what they've been fined, so they can put it in the budget. They've got enough dough to make it work, and everyone wants the share price, or wants the share, and the price goes up. So yeah, it's an interesting one. It's a funny old one that the old share market. And I remember hearing a comment once from Robert Kiyosaki when I was doing one of his courses, and he said, a lot of people trade the noise in the share market, right? So there's a lot of noise. That sort of short-term volatility and those things is where if you've got the cojones for it, you can play in there, can't you? Well, but really, at the end of the day, talk about long term is better, right? And it absolutely is. I mean, short term is fun, but like you said, you got to have the kahunas to go into it. So here's a really interesting date to block into the calendar. Is Spring Racing Carnival. Lock it in there, because we will have the Reserve Bank meeting and discussing what they're going to do with Australian interest rates, which I think it's sort of unanimous against all of the economists. I think that it's going to drop to 0.1%. So breaking new records is the theme. Mate, it's going to be a record.
just competing with the rest of the world to see how low we can go. We'll probably end up with 0.000001% from the interest rates. But so that date is actually falling on and bridging over the election, the US election, which is going to be quite pivotal to market sentiment, one way or another. Yeah. So what we're going to have is, in theory, we're going to have what would usually ring true. RBA drops rates, stock market goes up. Then we're going to have, within that same period of time, we're going to have the election over in the US, and that will drop shortly after, or kind of bridge that gap as the RBA announcement. And we're going to get the US election announcement. So we're going to see a massive amount of volatility between now and then. And mate, I've got my finger on the pulse when it comes to a few of my Kahuna trading apps that I will take a punt on a few positions that I've been looking at for a long time, and on the lead up into there. And I'm not suggesting people do this. This is fair income gambling, but I'm not going to bet on the horses, but I am going to bet on a few big stocks running into it. So for those of you who want to have a little bit of a dabble, don't go to Sportsbet. There's a potential that you could be running a very, very different race with some very, very big global companies, and it'll be extraordinarily interesting to see the volumes. I'm going to call it here. Two calls. The first one that relates to this conversation is that I reckon we will see one of the largest volume trading periods over that 2 to 3 day cycle of the election than we've seen, since COVID hit, and possibly in the last 3 to 5 years. That's my call. Don't know whether it'll come true or not, but
so clarify that. Explain that a little bit. So you're talking about trading volume. Is that the number of shares, or the dollar amount, or a combination of both? Explain that bit. For me and others.
It's the liquidity of the market, effectively. So and the volatility. So high frequency or a lot of trading, it's volume. So it's the amount of stocks that have swapped hands over the course of the day, both by number of stocks and the value of stocks. So, we could see, multiple billion, traded over the course of the day, and that's split across, the S&P 500 and so on and so forth. But I think we'll break some records on trading volumes here in Australia, and I think we'll break some records over in the US. Just my feeling, because the other thing was that was talking with a behavioural economist, and I might have been you as well, that saying that they've now got proof that a lot of people have gone from sports punting to stock punting, because they haven't had the hockey to watch and start betting on. So these avid bettors, these avid punters have gone out of the TAB and jumped into Goldman Sachs, or gone into stake trading platform, or and they've started betting on the markets based on whether there's going to be stimulus. There's all of these different types of mechanisms, and there's these apps that are making some outrageous statements in and around how to get in and out of markets, like brutal. And the wash up of that is going to be terrible. There was already a young fellow who committed suicide due to trading leveraged instruments through Robinhood. And but I reckon there's going to be a really interesting wash. So if you're going to have a punt, bet carefully. That's my tip. But what a season to bet. Don't bet on the GGs. Go and bet on Goldman Sachs or somebody like that for the day.
Something a bit more interesting. And so tell me why you believe the Australian stock market will be affected with the American elections. So I'm always interested in that, because from a property point of view, it's almost irrelevant. Directly, sometimes indirectly, there are things, but so can you give some insight to that world? Because I'd be really curious to understand, what the connections are.
Well, all you need to do is you need to look at where trading finished up last night with the S&P 500. That was down. Australia finished down on the All Ords, down. Not aggressively down, but nine points down. And wasn't aggressively down in the States. I haven't looked yet today because I've been in appointments all day, but I'd venture to say that through today, and if somebody's watching and can make the call on this, I would say that potentially stocks like AGL, like Woodside, some of those more value-based stocks, I reckon that those ones might have rallied. I haven't looked. I have no idea. But if that's the case, it just shows how strongly Australian markets mirror the US. Right. And one of the reasons behind that is that, we're trying to figure out the direction. There's so much uncertainty with COVID and how markets are going to unravel, that it's kind of follow the leader a little bit. And to a degree with stimulus as well, I'd venture to say that there was no reason for the Australian government to blow the stimulus cap as aggressively and as quickly as what they did, right? And I do have a slide on this. I'll just see whether I can find it. But they blew the stimulus, and I think it was almost, or my take on it is, it was almost a function of permission, because the US dropped an absolute stimulus bomb, and as a result, there was a bit of leeway given to the rest of the world to do it. And so Australia jumped on it and basically dropped a bomb that was about 9 times our GDP. All right, that total
America's stimulus. Wow.
Now, if you
What was their
compare
stimulus? That's huge.
yeah, and so you'd be thinking, well, Andy, but everyone else has done the same thing. But the beauty is, and if I can find it here, it's a really great slide, even if I do say so myself. Well, I can say so because I didn't design it. But and I hope I've got it here. It's in my old wine and wisdom stack. Yes, here it is. Jace, coming. 3, 2, 1. Shit, we're almost there. Technology is not Andy's friend today. Still not his friend. There it is.
Yes.
So as you can see here, this was by NAB. You can see that we've got ours over on the right-hand side. So that was after the budget, which we now know is a stimulus package, not a budget. So the budget. So it was, sorry, not 9, it was 11 times our GDP. But have a look at, and I have cut it off, so you can't see that, which is a bit unfortunate. But let me just decrease the size of this. Let me see if I can pull this back out and maybe widen it up. No, we can't. But I know it basically in order. This is Italy. This is France. This is the UK, right, as an example, US. So we have stimulated far more aggressively when it comes to the volume of our GDP than some of the hardest hit countries in the world, as far as the numbers, and certainly to see France down there as well. So really, really interesting from that perspective. So coming back to your point, why will the Australian market react in regards to what's happening over in the US? Well, the first one is the rate drop, right? So all other things being equal, rates drop, markets go up. So the RBA, even though we know that they're going to cut, will probably go up. Even though that's already factored in, right? But then we've got the US that's very, very polarized as far as they don't know which direction to go in. Are they going to go for globalization, which will be more in the Biden camp, or are they just going to go for more lunacy, which is obviously, you know, our orange friend? And the divide between the policies is dramatic, right? Is absolutely dramatic. But here's the thing, I think that markets will fly either which way with any degree of certainty. That the thing that we've got to watch in the States is that they don't end up with a hung Senate, right? So somebody needs to win with a majority. And because as we know in Australia, we had a decade worth of basically a hung parliament. And that doesn't mean a whole lot of men with big, you know what I'm talking about. A hung parliament is basically when you're hung. You can't do anything. You've got no ability to pass legislation or make any difference. And during the time of crisis, it's imperative that we can actually make moves, good or bad. I remember saying it in the days of Gillard and Rudd. It's like, for God's sake, even if it's a bad decision, go with the decision. You know, Dan Andrews, East-West Link, just do the goddamn deal rather than waste $1 billion. You know, at least even a bad policy implemented ineffectively will have a greater amount of positive impact than no policy. So that's the big thing that we're going to look at with the US, and why I think that Australia is going to react very much on the back of it. But let me just say this, Jace, it's noise, right? So I don't say that long-term direction of markets are going to be pivotal based on this election. We're going to see a big amount of noise, and I can't wait to be a part of it. You know, it's going to be yep, we're going. Oh. So I'm excited. I think it's going to be a cracking race. It's going to be a letdown either which way, you know, Biden or Trump. But hopefully they both survive it. So mate, that's my little wrap on the markets.
That's a wrap on the market. Well, mate, you know, it's always good to get a bit of an eyeball or an airball over the fence in the world of the share market, because it does travel a lot faster than the property market. That's for sure. You know, One day it's great, and next day it's you know, a little bit sad, and then the next day it's good again. So you know, there's always something to talk about, that's for sure. But
that's true. And so big shout out to Julie Fletcher. I'll never think about a hung parliament again without thinking of that. Well, you're welcome. You're welcome.
Oh, okay. It's good to see Jules is in, and Jules said that she'd be in on our trading challenge as well. So when we get our things rolling,
it's a foot, Jay. So get your butt into gear. I'm already 2 trades ahead of you. I got into GE a couple of days ago.
I sent my application back, Andy. Sort me out. Mate, I love it. So for those who are listening in, Andy and I, we're going to do some live trading on the show. So together we're going to choose some stocks and buy some assets and do some cool things, and just to sort of, you know, have a bit of fun with investing in and around our personal opinions on, you know, what we think's good and those sorts of things as well. So we'll see how we go. So that'll be a bit of fun. I'm looking forward to that, Andy.
We should name it the Little Short.
The Little Short. like it a lot. Well, over in my neck of the woods, mate, records being broken everywhere. The records of real estate. And I think I might have mentioned a couple of these for last time we got together. You know, I might have mentioned a couple of these, but I mentioned a $22 million sale down in Byron Bay. You know, $1.15 million record sale of a piece of land up in Brisbane. Record budgets or record stimulus in our economy. Record overpaying, $10 million overpaying at reserves at auctions. Records in the negative, record reductions in stock and dwelling construction, record population reduction. You know, we've been traveling at not population reduction, immigration reduction. We've been traveling at you know, 200,000 people on average for many years. So we've had a record change in that number. Record lowest interest rates in history. Record number of first home buyers entering the market through $25,000 stimulus. Record first home buyer stimulus of any government ever in history, or owner occupier property construction stimulus, and record number of land sales in 1 month in Queensland. And the records go on. And I reckon we're going to continue to break records, good and bad records in this space. But for me, a lot of this stuff is lining up to pretty significant fundamental pressures when it comes to the real estate market. You know, you'll talk about the RBA dropping the cash rate when it meets next, and you know, it's getting down there. You know, record lowest cash rate in history, I think now. Even it's the lowest in history, and you know,
2,000 years, wasn't it, Jason?
It's true. That was our call last time, wasn't it? Last week, you know, which is crazy when it comes to, all right, well, you know, the money's worthless in the bank account. You know, what's going to happen? And I think we'll see, like you're predicting, Andy, record investment money leaving institutions and entering marketplaces when it comes to real estate and other bits and pieces as well. So, mate, the big records are being set or being challenged, and I reckon there's going to be some record breaking over the next 6-12 months in this sort of space as well. You know, in the short term, I had a bunch of good communication from the world of Melbourne about real estate over the weekend. I've got an agent down there in Jellis Crag out of Melbourne, and he said they sold a bunch of properties down there very quickly, and his marketplace is warming back up real quick. And he said people are back out and about. Sales are actually going to go very well. I think the rentals will lag in Melbourne, but the sales are off with a cracking start already.
Well,
we've already had a weekend of really strong sales.
I just happened to have a chat with a good friend who's opened up another real estate business down here on the peninsula, and I won't disclose their names because I might say something wrong, but effectively they were saying that that it's just been going off down here, down on the peninsula. So for those of you who don't know, the peninsula is Mornington Peninsula is about 40 to 45 minutes or an hour and a half, depending on how deep you go, away from the city. A pretty easy drive, and ocean one side, bay the other. And apparently, but it is as strong and as buoyant, if not more so than coming into COVID. And that is with virtual, because we're on harsh lockdown here. So that's with virtual seeing. And mate, I don't know about you. I've rented a few apartments in my time, and those rooms are never as fucking big as they look through that fish lens, right? You go, oh, this place is a cracker. It looks massive. And people are dropping extraordinary amounts of money, sight unseen or sight seen through a fisheye lens.
Yes.
It's incredible.
Well, I mean that sale, or this sale here, which is Byron Bay, that was a sight unseen. International celebrities, right? Purchased.
Like, unbelievable.
Yeah.
And look,
having a look at yeah. So I mean, it's certainly true. What's that one there?
Well, some of the reason behind this, and we ran an investment seminar just the other night for our private clients, and dropped a few of these slides. I won't go into the highly contentious ones because could end up behind bars, like Wazzy Macram's bowling counterpart. But we talked about the 60-40 portfolio being dead. And as you can see on the right-hand side here, the 40% used to represent the defensive part of a diversified portfolio. 60% in property, shares, derivatives, think of growth assets, and 40% in government bonds and high quality corporate bonds, those sorts of things. And so it wasn't long ago that we were getting 6%. So if we imagine a $100,000 portfolio, for that 40,000 that was invested at 6%, we were earning 2,400. Right? If it was $1 million, it's $24,000 when you store your money in the defensive part of the portfolio. And it's been a lot higher, but that's been the lowest that it had been for 20 years before, 5 years ago. And then now that 40,000 is actually giving you 400. So knock out the $2,000, Jason. It's giving you $400 return. So, and this is the other thing. And I didn't have this slide for you last time, but this is one which I prepared earlier. But what a lot of people don't know is that bonds actually have capital risk if you trade them. So you can buy a bond for 3 years, for 5 years, for 10 years, for 30 years. And if you have to sell that bond to somebody else and interest rates have dropped, then you make money. And a lot of people don't understand this. So that 40% of the portfolio, right, as interest rates had been dropping globally, that's global interest rates. So that's UK, Australia, Japan, Swiss, France, and USA. So as interest rates drop, right, your bond actually increases in value. And the converse is true. So at the top chart here is just a bond that was valued at 3%, and then the interest rate fell to 2%. So if you sell that in the open market, well, if you purchased it for $1,000, you're going to sell it for a premium, right? Because you're getting paid a higher interest than what you could get in the market. So that bond went up to $1,082. So that represents an 8.2% increase. But if we flip that and go to lowest possible interest rates, then we go, let's say it's from 3% and it goes up to 4%. Well, that $1,000 bond is now worth 925. So that's a negative 7.5%. So I assert that this is the kind of case with defensive assets at the moment. You have unlimited risk on the downside, and you've got very, very limited risk on the upside. We've basically taken the defense out, and now we've got an open goal. But if you're an investor, you're sort of sitting there going, well, would I put my money in the 40% anymore? And I believe that that is a big part of what's happening. And one of the things that we spoke about in the investment seminar that we ran was, where do you go for good defensive plays that are not aggressive?
Yeah.
Right. And most people, like we said last week, will view property, residential property, as something that they're more familiar with. So potentially that is a safer defensive asset.
Yeah.
And
yeah.
I think that that is going to really fuel the idea of real assets is going to become a real investment tool moving forward. And some of these old paradigms might need to shift and catch up.
Well, and I think, Andy, what part of the prediction for me is, I believe, as we see, and I'll reshare where I was at here. As we see this gap here, which is the gap between the supply chain, the dwelling stock, and the population, that gap become pretty significant. We're going to see that pressure become even more. And, I certainly believe the internal machinations for pressure on real estate prices are going to be, in the short term, brought by people like what's happening right now, with people from Sydney and Melbourne wanting to go somewhere else. And it's either localized with what you're explaining, with your, local pressure on your prices, because where you live, it's a little bit more lifestyle, a little bit more less dense, and so on. And then people are, and you and I, even in our K2, our Kerwin Ray, elite program, I've got, you and I've got two people right now who've moved from Melbourne, and that now they're living in the Gold Coast. Like, we know two people, like right now within the COVID period, have said, nah, that's it, fuck it, we're out. We're moving to the GC. We're moving to Queensland. We're moving to somewhere different. And they're sitting here in Queensland right now. So,
mate, for a Victorian to move to Queensland, you have to do something serious. You know what I'm saying?
Mate, that's a big choice. That's a big choice.
AFL to rugby. I mean, you've got to have a frontal lobotomy for that to happen.
That's true. It's true. And John, he loves his sport too. So but I certainly see. I certainly see, when that gap gets intensified, the attractiveness, the yield attractiveness of residential real estate will increase. Right now, we've actually had some pressure nationwide in rents not to go up for actually quite a number of years. Even forget about COVID, as interest rates have gone down, the rental increases nationwide have actually been quite low, if not non-existent. Because there was a bit of stock available in certain places, and the interest rates went down. So there was no real cost pressure to the vendor as interest rates tracked downwards. And so what we're happening now is we're going to find the bottom, but now there's going to be some pressure when this difference happens here, when there's more people and less stock. We're going to find some pressure. The rents will go up first. What happens always is rents go up first. Like, when the rents go, the values follow later on, when there's a bit more certainty in the marketplace.
Well, basic sort of desire for real yield. The rents go up, then it becomes an attractive investment. Exactly.
And my sort of long way around of going to back up your point is, right now, maybe those yields are 4 or 5%, and you're going, well, the defensive assets 2/5 of nothing. 4 or 5% yield out of a residential piece of real estate is quite nice. Well, mate, what happens when it's 6 or 7%? That's going to accelerate this thing, because we saw it. I saw it at Positive in Sydney after the GFC. We were getting 7% rental yield in a capital city. And I believe we'll get back there within 2 years. Like, I think we'll see in certain cities, we'll be getting 6 and 7% rental yields. Already, we've just done a deal in Canberra and the average yield on a brand new property in this location was 6.5% anyway. So I see in certain places we're going to be getting 6 and 7% yields before the prices move. The rents will move in certain places. So it's certainly not going to be Melbourne for the short term. I think Melbourne's not going to enjoy that pressure for the moment, but certainly places like Brisbane. My call is this: Brisbane, Perth, Canberra, maybe even Adelaide and Hobart, but they're outliers. Brisbane, Perth, Canberra are going to receive some pretty significant rental pressure in the next 1 to 2 years. That'll probably accelerate that thing that you're talking about, people leaving very low value defensive assets and seeking them in residential real estate. So I think it'll exacerbate the problem personally.
Yeah, it's going to be interesting to see it play out. Like, there have been similar dynamics in history, and maybe I'll bring an example. It'll be very, very difficult to talk about it without illustrating it, but because it's quite complex. There have been times in history where interest rates and inflation have actually been in a similar position to where we are right now. It's just the dynamics were different. You know, the rates were high, but inflation was higher, which meant that you had a negative real yield. And I think if we look back at those points in time, those are those periods of time in property where that cycle that expanded, right? Because ultimately you need, as an owner of property, if you're renting that out and you're paying a 7% yield, paying a 7% interest rate, well, you need to charge more because the holding cost of that property is greater. But that dynamic of the 30-year dropping interest rate has actually been able to subsidize the commercial rent and the individual's rent of these homes over time. But you've lost a lever now. You can't pull on it anymore. Just ask Japan.
It's not there. It's not there. And I think I've said this a few times in our conversations. There's no lever. So as the property market deleveraged or the interest rates declined, more and more the quality of your property needed to count for more and more. So in reality right now, the quality of the property in whatever version of the world you call quality, the quality of the location, the quality of the property's rental ability, the quality of the property's owner-occupier appeal, you know, the quality of the property now counts for more than ever before where the value will lie, right? Because interest rates going down will not make up for the poor quality of the property, okay? So because in my world, when you're doing buying and servicing for an investor, you know, you basically, you know, if you've got X income, if you've got $100,000 of income and interest rates went down and servicing, like the ability for you to borrow, changed or improved, then you could, the prices people were asking for average property could be sustained because, you know, it wasn't, you know, but now it's like, well, money's cheap. I can choose anything. I want to buy a good thing. And I believe, and this is where I think these records are going to be set. I think the gap between quality assets and rubbish assets right now are going to, like, it's going to become larger than we've ever seen before. It's certainly in real estate and maybe even in the world of stocks and shares. Like, you know, the quality things are going to receive the capital and the investment and the value, and the average things, the things that were sustained because money was cheap or you didn't have another choice, I think are going to be, you know, end up being priced appropriately where they should have been priced. Probably in my assertion, there's a lot of rubbish property that should have been priced a lot less in the last decade that just got priced inappropriately, as far as I'm concerned, in the marketplace, because there was no other choice. You know,
well, part of the debt funding arrangements and that sort of super cycle that went past, whereby, you know, it seemed to be a bit of that helicopter dynamic where, you know, the money seemed to be bigger in the hands of the investor, And as a result of it, it ended up, creating a super cycle, because there was the $100 note was bigger in the hand than what it ever was before. And that dynamic is going to continue to happen a little bit as the helicopter money comes out, but then it'll flatten off. And I think that the other key theme that, and I'm no property guy, Jace, but I'd be looking at this. I'm looking at this from an investment play for investors, but I would have thought that is a key theme, infrastructure, when it comes to where is the new hot zone, or is the hot zone just going to be the hot zone because it's the hot zone? And if so, if we're building new infrastructure, which we will be en masse, if there's a new airport going in, like these scandals, which I hear about, I haven't read enough to quote on it today, but I hear that there's been a bit of political shuffling around in regards to the acquisition of a proposed airport. But if they're going to throw in an airport, as if they put in the airport that they originally were meant to down on the peninsula down here, prices of property down here would fly. And pardon the pun, that wasn't intentional, but quite quick-witted from the subconscious mind. But if they did that, property prices would skyrocket. And
infrastructure always does that for real estate. That is for sure. Yeah.
So, mate, there's a couple of questions coming through.
Yeah, I'm not getting any comments on mine, Andy, so you might need to read them out, because nothing's coming through on mine. I was about to mention that. If anyone's got any questions or wants to chuck something out there, chuck it in the comments, because nothing's coming through on my positive feed, but maybe on Andy's feed it's coming through. So, but yeah, mate, like while everyone's maybe responding to that, shout out for, chuck some comments in the feed. The infrastructure investment is absolutely a golden opportunity to see where there's value, certainly in the real estate market. Many years ago, I owned some real estate up in Katoomba in the Blue Mountains, which is kind of up and out the back of Sydney. And I sold it just before the freeway went in from Sydney all the way to the Blue Mountains. And literally, 5 minutes after I sold it, the property price literally tripled in value. And, it was one of the big lessons that I learned about, infrastructure many years ago. That was one of my first properties. I bought it for, in the hundred thousands, and, it resold many years later for, over triple its value that I purchased it for. And, that infrastructure drives that value pretty significantly, that's for sure. And, but, the infrastructure investment right now, the government's sort of sitting on its hands a little bit when it says it's proposing some ideas, but as soon as the government says, yeah, we're going to put some money in this, I think that's going to indicate very, very strongly, where real estate will benefit. And you and I talked about it last week or the week before, even. I think we've talked about it 2 weeks in a row. We believe. Well, I certainly believe, if money's so cheap, the government should borrow another $1 trillion and spend it on appropriate infrastructure. Let's face it. Australia needs decent infrastructure. I mean, the country needs from a tax base about 40 million people in the country. That's what it needs. Like we are a massive country, and we just don't have enough. We don't have enough taxpayers. There's not enough people here to pay the bills. And while I'm a big proponent of minimizing your tax legally through the right means, I'm a big fan of paying GST when I consume something. I like GST. I'm a big fan of GST. I'll pay GST, put the GST up, just get rid of all the other rubbish taxes. That's as far as I'm concerned when it comes to the Australian environment. But, let's build some decent infrastructure. Let's build some high-speed rail. Let's build some water, some significant water assets. Let's build some things that are great for the country, not half-assed fucking NBN bullshit that failed before it even started.
Well, there's an interesting point on that one. But mate, did I just hear you say what Australia needs is for younger people to go out there and breed more often? I think that was reminiscent of Was it Keating or was it Kennett back in the day? You know, you should go out and breed.
One for you and one for the country. That's what we need.
The bed session we had to have, I think it was called back in the back in the day.
Exactly it.
But I was having a chat with Malcolm Palmer the other night from Joseph Palmer and Sons, an incredible investment firm, had an incredible brain, and I was chatting because I was quite bullish on a few things. And this isn't a recommendation, but when I see Telstra, which is a pretty staple stock of Australia, when I see it where it is, and I look at it and I go, it's still paying a great yield on it. I go, how can I leave my money in a cash account and not put some in there? And so when I said that with gusto and enthusiasm, him being the broker or the equity guy, reined me back in, which was unexpected. And but the conversation led down a very, very different path, which was Elon Musk came back in. And so how many satellites do you think Elon Musk is getting into space?
Oh, I know the answer to this one. I was looking at it the other day, and Andy, it's huge amounts, right? Has he got is it 150,000 satellites, or it's a huge number, right?
It's I think it's in the 2,000 to 3,000 category, but
2,000 to 3,000.
That's
well, there you go. Yeah.
Well, just let's not get it in the way of a good story.
That was pretty close.
But so one of the big risks to infrastructure like that is that this is meant to be this satellite, not the satellite broadband bullshit that we have, but this is meant
the low orbiting satellite broadband. Yeah.
Correct. So again, another example of how Australian companies can be, very, 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 very quickly fall victim to technology and large technology companies. Whether Australia would actually let that sort of competition come in, I'm sure the ACCC would have one or two things to say about it. But I'm sure that, that I never thought about that as far as a medium range factor to take into consideration when looking at buying a Telstra stock at this point in time.
Well, Andy, it brings up a good point. It's really interesting, and this is where maybe the old gloves of shares versus property is an interesting one, because maybe the value of a company has international competition, right? Not quite a lot of companies have international competition. So when for example, right now you're talking about Elon Musk just chuck a few satellites up, and Telstra NBN is struggling. The same thing could be said for banking, right? Like you and I have chatted about this when it comes to Bitcoin and the blockchain and all that sort of stuff. Far out, man. Once the world realizes that, I don't really believe in NAB. I'm just going to put my money in, X Bank, which is an online bank, which is not onshore, and there's some interesting competition in that, and maybe I'm myopic, maybe I'm naive when it comes to real estate, but if you're going to live in a house in Australia, where's the international competition for the house in Australia? Is it the pricing?
They're at the auction, mate. They're at the auction.
They're paying 10 million over the auction. Well, you're true. Actually, it's true. It's true. And so, yeah, it's a funny one, huh? It is really so that is the thing, right? So, but Australia is attractive in real estate terms to a lot of people in the world, right? And technically, for the value of its lifestyle, it's really inexpensive for what it is. So
you just can't help yourself, can you, Whitten? Every time you have to bring out the old lifestyle card while we're locked down in Victoria, you just can't help yourself. Just grab that little knife and just twist a little bit harder. Unbelievable. People don't listen to him. Don't listen to him. He's nasty. He's a nasty pasty.
Well, when we're not in lockdown. Well, I mean, hey, another record. Melbourne broke a record. Longest in lockdown in the world. There you go. Another record we broke. You know, fuck, we're breaking records everywhere.
First grand final out of Victoria.
There you go. It's fucking true. That's crazy, huh? Well, mate, you know, it's a really interesting thing to sort of think through when you do talk about the Elons of the world. Like they're of the world, not of a country, right? You know, and you know, how do you price that? How do you cover your risk there? You're dead right, you know.
Yeah, well, it's a good sign for all of us, and possibly as we're starting to come to the close, and we'll finally get to Julie's question. But if you do have any questions, think about them or put them down into the page. But and also for business owners out there, geez, there should be a truckload of questions coming through because the stimulus still hasn't been fully put into force. The last stimulus package, aka budget. Geez, didn't Frydenberg look like a deer in the headlights? And he was doing that little interview session. It was the most set up thing. Like it reminded me of grade 7 drama, and like nobody should ever have to go back and sit in grade 7 drama again, but we did. So whack in the questions because there's heaps to cover on that. But Julie, this one's for you, mate. Is it harder or easier to get interest only loans on investment property?
So if you would have asked me sort of six months ago, I would have said it was lot harder. But right now, interest only loans, if you look great to the bank, as long as your income is pretty straight 180, interest only is back with a vengeance. So there's plenty of choices out there. You know, I've chatted about this in a few of my videos that I've done, Andy. You know, interest only does not mean you're not making extra payments. Interest only means that is the commitment to the bank. That's your minimum commitment. You can, one, choose to make extra payments into the loan if you want to. I wouldn't encourage that. That is not my advice. I would say interest only loan with an offset account. You make the extra payments that you're prepared to make into your own offset account because you want access to that lending. You want access to that cash. So the answer is no, it's not difficult right now for interest-only investment lending. It was 6 to 12 months ago, almost impossible. And it was causing a bone of contention. And give it till May next year when the banking gloves are off, the APRA gloves are off. Another record, I'm predicting another record. I predict record lending numbers come it's actually March, not May. March next year, it will be on like Donkey Kong when it comes to lending and us getting access to funding because everyone needs the money. So, yep. Hopefully that answered. Was that Julie's question? Hopefully that answers Julie's question. It's not difficult.
That was Julie's question.
Yep, it's not difficult right now, and it's only going to get easier as we progress towards March.
Yep. Yeah. So another one coming through, this one from Dean was, got a property in, a specific one, got a property in Shitsville in WA, back in the old mining villages, south of Perth. Yeah. And we've suffered an equity position. We're now trying to figure out whether we hold on to it or whether we take out our position and then go and find a better asset somewhere else.
Yeah, 9 times out of 10, I would say take out and find a better asset. It's kind of like hanging on to a loser forever. You're thinking it's going to make a comeback. It's never going to make a comeback. My caveat around that one, Andy, is that sometimes when you actually do the mathematics, it's not costing you as much as you think it's costing you. And sometimes it's actually easier or more productive to hold it. Just ignore it for the moment because, eventually it'll be a little bit better to handle. But I'd have to know the numbers to make a good call on that one. So it's a good question because I get it all the time, like we grew up on high rental yield regional real estate. That's how Positive Real Estate started. That's how we got our name. Positive Real Estate was, I remember buying $19,000 houses, that were renting for $120 a week. Those days were like crazy,
Was that 2,000 years ago when interest rates were actually below where they are now, Jace?
It wasn't that far ago. It was in the early 2000s, Andy. But I think I've said this once or twice, mate. The distribution of information for real estate was really, really flawed up until realestate.com in 2003. Realestate.com was a game changer for the Australian real estate market. And the moment that company launched and you could list your properties online and so on, now the speed of information and the speed of access to real estate around the country has diminished, very much like, not as quick as, but very much like the stock market. You can have access to the information and values pretty quickly, or approximate values. That's helped a lot. So, certainly if you're stuck in one of those mining towns that has really not a great predicted or, seen future, then the sooner you can exit with the least amount of damage, the better you're going to be, but it all depends on what it actually is truly costing you. Because I've done this before, and one of my, one of our worst deals ever at Positive is, a deal up in Gladstone many years ago, it was great at the time. We were in the, close to the 10% rental yields, 8.5%, 9% rental yield. And it was fantastic. Things were going great. But the cost, you got to do the cost. So if it's really costing you $3,000 a year on negative cash flow, and you're going to eat, $30,000 of loss on your equity, then, you've got to, if you waited 10 years, will it recover? Will you claw that back? And it does depend on a deep dive on the financials of the property, Andy, so hopefully that answers the question.
In derivatives, we call it a stop loss, right? So when you've got an equity position or a stock position or an investment position which is highly levered, and we're talking 1,000%, so $1 represents $1,000. So that's considerably more than what you're talking about with the property side. But what we do is we set margins of which we will not go below, because you're leveraging your losses as the market drops, right? If you've got 200K in and you got $1 million property and that property goes down 10%, that's $100,000 loss that you've got. That's 50% of what you put in, and that's the real deal, right? So 10% loss equals a 50% loss of the capital that you put in, and so that's what you've got to be considering when I think about it from an equity position, as far as equities are concerned. Got another one here from Greta. I'll comment on this before I throw it to you, mate, because I've been one of them for a little while. How do you get banks to give you an offset account for business accounts? I thought they only did it for personal loans only. Well, Greta, I think I might have read that wrong. I need my glasses and I don't even wear them. Yeah, that's it. Can you see, Jace? Let me bring it up. I'll hold it up to the camera for you, mate. Apologies. But so we went through this last week, and what Jason taught me is that they really are a bunch of bankers, bunch of wankers. Yeah, anyway, they're bankers, they're wankers, and a really, really interesting thing that we went through, and Jason blew the top off and flabbergasted me in it, was that the difference between a residential loan and a business loan relates to the security behind it, where you are covered by consumer law, was it, Jace?
Yeah, it's the consumer law. Yep. The
on
credit
the
code.
retail properties, and you're not when you borrow via company or trust kind of vehicle. So they separate them out so that they can have a fair income crack at you. So I thought that you still can get offsets in business world. I thought I'd seen a few of them around. Jace, have you seen? You would see more of this than me.
So you got to dive into the detail of the questions of these sorts of things. Now, it's certainly on a business loan, an offset for a pure business loan with no other assets involved, it doesn't happen. Like there's no offset.
I'm reading this as a business loan, so
okay.
That's attached to a security.
Yeah. Okay. So now, and this is where the devil's in the detail with this stuff, Andy, because it's really important to understand. Instead of the banks being in charge, if it's a business owner asking this question, which is a fantastic question, you never take an overdraft, with a bank and allow them to use your own home as security for the yep. There's it's a no. You become the bank to your own business. So, and what I mean by that is, if you've got equity in your own home, you get an equity release on your own home, and then you lend the money to your own business with a proper agreement, a proper terms and conditions, a proper bit of document and paperwork, and you become what's called the first creditor to your own business. So if it ever goes pear-shaped, the knock-on effect is limited and controllable compared to, I want an overdraft, and then the bank gives you an overdraft based on the same equity you would lend yourself. And so the reality is, I'd have to see the details of the question, but a banking offset, like a banking offset for a business loan doesn't exist. A banking offset for a residential loan absolutely is available. And if your bank is saying they're not going to give it to you, just leave that bank. The interest rates and the banks are really vying for business right now. I saw the latest promotion from CommBank. They'll give you $2,000 to shift over to them, cash back. At the end of the day, there's plenty of competition in that space. But this is one of those things I've talked about with you, Andy, about business owners, protecting themselves, and asset protection. A lot of people think it's about companies and trusts. Fuck that. Like that is the least asset protection. The best asset protection is your lending structures, how you fund yourself. This one we could dive into for hours, because it's one of my passions, to protect people about their lending structures.
Mate, I've been through a couple of rabbit holes this week with wonderful businesses, and thankfully catching it ahead of time this time, but just so many different ways of being able to do what is really logical stuff, but it's just not logical, because when most people make a property purchase or make a decision in their business, they're looking at it from the opportunity that presents itself, rather than trying to understand what is the best way to be able to embrace that opportunity. Because it's you're looking down the goal and you can see the goal directly in front. You got your blinkers on, you can't see the person who's about to tackle you, and you got a bloke who's free over there, and you can just dribble it across to him, and it's a sure thing. But quite often we get fixated on what we're looking at, and we don't step up and have a look around, and that's just life. But that's where the protection happens, and absolutely, I reckon there's a few podcasts with that one, Jace.
Mate, I think so, and maybe we'll sort of chuck it out to the listeners tonight. Andy and I are thinking of turning Wine and Wisdom into a bit of a podcast, and we're thinking of adding wine, wealth, and wisdom into the the heading of the podcast, or / Friday catch up as well. So anyone got any comments, chuck it in there. But we've been enjoying having these Friday catch ups, and we think we'd love to turn them into something a little bit more. And we're getting some support from people who've been listening in, which has been awesome. And Andy's mum's always supportive, giving us a thumbs up and sometimes an angry face when Andy's swearing.
she'll be dancing around there, mate. There was an angry face just popped up. That was Margot.
Yeah, mate. Listen, at the end of the day, the idea that we can sort of take this a little bit further, I think, a little bit of fun, and I think for all of us, we want to add some value to our communities, and really be able to serve more people. So we've given some thought about maybe pushing it out in a different way into the podcast, but I think it'd be great. I'm excited about the idea, mate. I'd love to do something with that in that space with you, bro.
And mirroring that, look, it's all about all of you who are listening. At the end of the day, I mean, Jason and I are going to catch up, and we're going to talk the world regardless. And we do it to try and better ourselves, to better the services that we give to our clients. That's ultimately what this is all about. But it's funny how we get onto here, and sometimes we're bombarded with questions, which is great, because there's, between the two of us, if we don't know the answer, we'll come back with it next week. And it happened once to Jason last week. I can't remember the last time it happened to me, but it has happened. It's happened to both of us. But that's our learning journey as well, right? Where we don't have the patent on every strategy. We don't have the patent on good ideas, and it's more the participation that we get from you guys and the interaction. So the more questions, and if you flick them out to us via Facebook throughout the week, then we've got the chance to be able to come back and respond. And I know, because I know many of the names up here ask me questions during the week and ping me or text me or call me or whatever the case may be. But it'd be great for the rest of you to throw those questions out and let us know what they are, so that we can ultimately focus the sessions on helping you. Because I can tell you, if you are thinking about it and you can't articulate it, then there's 100,000 other people and that are in exactly the same boat, and maybe 10 or 12 are on the call.
Yep, mate. Certainly, mate. Well, mate, it's probably a good segue to call it done and dusted for another Wine and Wisdom. Who's winning?
So
when do they play? When do they play? Like, mate, I'm the least sports fanatic person you've probably ever met. And when do they play, and who are they playing? So you got the Cats and the Tigers, is it? That's the two teams?
That's the two teams. This is almost like the slug picking the winner of the Olympics, isn't it?
It is. It is like, I'm just going to guess because I prefer Tigers over Cats. So,
No! No! All right, it's you against me tomorrow, big fella. I'm going to be a Cat tomorrow, and most Hawthorn supporters would think that's ridiculous. But for those of you who don't know, I haven't missed a grand final in over 20 years, actually, and I haven't missed being there, I think, for almost 30. And
wow.
So this is one of those moments where it's painful because I just can't be there. I'm not allowed to be there. But many of you will wonder how a Hawthorn supporter, yes, I have Hawthorn napkins. And it's to clean up the messy playing of all of the other teams, okay? Just so we know, all right? The reason why I do is because Hawthorn and Geelong, I think, out of almost any sports that I know of in the world, apart from maybe the Wallabies and the All Blacks, have one of the best historical rivalries that has spanned multiple generations. And I remember going to the Hawks games with my old man, who's a Geelong supporter, back when I was a little midget, still as vocal back then. And when Dermot Brereton and Dippy Domenico had a rib broken in front of me about 20 paces out, we have had the most incredible rivalry and competition. We've had more of the closest games than any other team in the history of the AFL. And for me, the business of sport, the business of business, the business of investing is about healthy competition. And you're in the property world. I'm more in the sort of the we'll call it the rest of the investment world. But it's that healthy competition that I think you got to look at it, and you got to respect it, and you got to admire it, because it takes two teams to create a competition that everyone can enjoy. And mate, the grand final is a great example of that for me, and that's the reason why I'm barracking for the Cats. But more importantly, mate, that's why I love catching up with you every Friday, because our worlds are usually polar opposite, quite often in the world challenged against each other. But
Yes.
mate, it's always a brilliant game when we get together.
Mate, ditto, mate. Good way to segue into the finish of the wine and wisdom for Friday, mate. So, mate, there also shout out to everyone joining us. Thank you for dialing in. I couldn't see anyone's comment on my end today, so I do apologize if anyone commented on the positive page. I can't see any comments coming through, but Andy saw a few at his end. So I do apologize, but I will chase them up after this and answer them if they're there. Thanks, mate. Great to chat with you.
Thank you, brother.
Awesome to join. And thanks for everyone joining in. You got the closing vid.
And go the Cats. Happy grand final weekend to all Australia.
White and red, Tigers.